Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday Market Update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks to watch, economic news that could highlight the week, and frankly, I'm having a little bit of a deja vu this week, okay? It's from an article in the Wall Street Journal on how much older investors are keeping in stocks, with more than half those 55 years and older holding 70% or more of their portfolio in stocks. I've heard those same statistics before the 2020 pandemic and the 2008 financial crash, and they're always followed up by heartbreaking stories of investors wiped out just before retirement. That's why for today's main topic, I wanted to save you from one of the biggest traps in investing, one that's going to take your hard-earned money and make those decades of investing all for nothing. I'm going to show you how to invest, how to avoid that trap. Stick around after that. We'll do our Monday market update with all the stocks to watch this week and the economic news to follow. First though, the revenue share IPO for Let's Talk Money is closing in just 4 days. I won't be offering more shares for at least a year, so this is going to be your last chance. If you're still unsure about this, click through the offer page I'm going to leave in the description below to find out how this investment is going to work. You're going to get monthly income from the revenue generated on this channel. You're going to get special perks and access, including investor alerts and investor-only live streams. I've been planning this for 2 years. I wanted to share the channel with you out there in the community, and this is a great way to do it. You're going to get that monthly income from the revenue generated. You're going to get those special perks and access and be a part of the investor community. So click through, take a look at the question and answer section if you have any questions or ask your own. If you're still unsure about this, just grab at least a gold tier token for $31. Unlock those investor perks and the special access, and you'll also have instant access to the secondary exchange market when it opens. But remember, this IPO on shares closes July 13th in just a few days. I won't be offering shares for at least another year or longer. This is going to be your last chance to get that monthly income from the channel. I want to get back to our main topic though, because that recent article by the Wall Street Journal was saddening but not surprising. Reporting data from Vanguard, it found nearly half those 55 and older were holding more than 70% of their portfolio in stock. Fidelity data backed that up, showing 4 in 10 of their investors aged 65 to 69 were holding more than 66% of their portfolio in stocks, and 20%, 1 in 5 of those 85 and older are holding a 100% stock portfolio. And think about that for just a minute. Okay, 1 in 5 investors 85 and older are betting everything that stocks will continue to go up. Now, yes, most investors know that they should be protecting their money with bonds and some other assets. And talking to older investors, though, it's always the same story, okay? They always say, I just want one more year of those returns growing my portfolio, then I'm going to adjust to that safety outside of stocks that I know I need. And folks, unfortunately for so many investors, that's where the pain starts. Okay, I've heard from more than a dozen people from 2009 to 2012, folks that were within a year or two of retiring but got caught up in that crash and had to work another 5 years or 10 years or longer. Even though stocks rebounded quickly during the pandemic, it didn't help those that needed it most. I know several pre-retirement investors that saw their hopes plunge along with stocks back in March of 2020. They panicked and sold near the bottom just to protect whatever that left where they could, and they never benefited as stocks rebounded, as stocks boomed higher there in 2020 and 2021, and they're still working. So for those of you within 10 years of when you want to invest, pay attention here, okay? For those of you younger investors, put what I'm about to say in your back pocket because I guarantee you will need it. And yes, I know a lot of you out there nearing retirement, you feel like you haven't saved enough. You feel like just anything less than 100% stock portfolio isn't going to get you anywhere. You need that extra growth for just a year or two. Then that's fine, but what about losing a third of your portfolio in a stock market crash? I'm not saying it's going to happen, but it does happen. Where would you be then? I'm going to tell you, you're going to be picking up that extra shift at Walmart when that happens. And avoiding those ruined retirement plans comes down to just following a few simple rules on investing as you get closer to your money. I'm going to cover how to invest 10 years out, 3 years out, and then during retirement to protect your money when you need it most. But it can come down to using something as simple as the 110 investing rule. This simple investing rule just says take 110 minus your age. So say if you're 50 years old, let's say 110 minus 50, and what's left is how much you can safely have in stocks. So for someone 50 years old, that means 60% in stocks and the rest in bonds. I would prefer more of a stock, bonds, and real estate portfolio. Just diversify your money out a little bit more, get you that cash flow from real estate as well as a little bit extra returns, not have to have so much in bonds that it kind of holds back your portfolio return. So maybe something more like 55% in stocks, 25% in bonds, and 20% in real estate. This is still going to give you that upside growth in stocks and real estate, but also that safety that you need from and the cash flow in the bond portfolio. Okay, if stocks do fall, you're going to be protecting your money. You can even take advantage of some of those lower prices in stocks by selling some of your bonds then and buying those stocks. Now, apart from that rule of 110, you should start adjusting your portfolio no later than about 10 years out from when you're planning on investing. Okay, I don't want to say from 65 or 55 or set any age on it because I know some of you guys want to retire early. 10 years from when you're planning on retiring, you need to start adjusting your portfolio to the safety that's going to keep your assets safe and keep them there when you need them. It took 6 years for the S&P 500 to recover its prior peak from the 2008 crash. 6 years. Okay, stocks had just recovered their 2000 peak in 2007. 5 months before starting the next bear market crash. So if you're closing in on retirement within 10 years or so, you cannot afford to get wiped out by a crash. You just don't have the time left to recover on your portfolio. So here that means not only shifting some of your money into bonds, so at least 30% into funds like the Vanguard Long-Term Bond ETF, that ticker BLV, or the iShares Aggregate Bond Fund, ticker AGG. Also taking a look at some of the stocks within your remaining portfolio. You're still going to need some of your money in stocks for growth, but start shifting some of that portfolio into those safer sectors like consumer staples, healthcare, and utilities. As stocks, these are still going to grow along with the economy, providing those returns, but they sell services and goods that we have to buy. Okay, healthcare, staples, and utilities, they've got much more stable cash flows and much less volatility than other stocks like growth, like technology stocks and communication services stocks. Okay, these are the stocks that are going to protect your money in a stock market crash. For its part, real estate stocks or REITs plunged 25% last year, and 2023 doesn't look that much better, but don't forget that the group was the best performer in stocks for 5 of the 6 years following the 2008 crash. So eventually, when interest rates do start coming down, those real estate stocks may provide some of the best returns as well as the cash flow and diversification away from stock volatility. With 3 years out from retirement, this is where you want your money really set in stone and there when you need it, with less than half your portfolio in stocks. Okay, you might still have maybe 45% of your portfolio in stocks, but it's really going to be like the 35% in bonds and the 20% in real estate stocks that's going to guide your returns and your risk. Now, the most important factor during retirement is really the speed at which you withdraw your money and the danger of a stock market crash just wiping you out. Okay, advisors call this sequence risk, right? Okay, that's the risk that the market falls just as you're in your early years of retirement. For example, if you needed about $48,000 a year in income, about $4,000 a month, and that happened to be about 4% of your portfolio, you could be fairly confident that you're going to outlive your assets, all right? That your portfolio is going to grow enough to cover that 4%. You're not going to run out of money before you end your retirement. Okay, but now if you get hit by a stock market crash in those early years, wipes out maybe 35% of your portfolio, that $4,000 a month jumps to a 7% withdrawal rate. You are selling stocks at the bottom just to pay your expenses, and you're probably going to be broke before you croak. So that's why during retirement, a safe allocation in stocks is probably no more than 45%. Okay, maybe 45% if you hold those safer sectors like utilities, healthcare, and consumer staples, rather than those growth stocks. That's going to give you that growth that you need to beat inflation, but also the maximum safety in bonds and real estate. Okay, if stocks do crash, you're going to be able to sell some, you're going to be able to fund your living expenses for a while on those bonds, let your stocks recover for a few years, maybe even take advantage of some of those lower stock prices. I want to look at our Monday market update, some of the stocks I'm watching this week. First up here, Coinbase Global, ticker COIN. This is up 138% since the beginning of the year, with much of that in the last month, just on those strength in crypto prices and hopes for an eventual Bitcoin ETF. Now, the stock is trading expensively here at 5.8 times a trailing revenue, so 5.8 times, almost 6 times price to sales. Could be about to face a rough quarterly earnings report when it's scheduled to release on August 7th. Okay, reports last week that crypto trading volume in the second quarter dropped to the lowest level since 2019. And remember, Coinbase is still completely dependent on that revenue from crypto trading. Okay, management may be able to provide some kind of, or talk up that future potential, and there is future potential in this stock, in this company, but the present remains extremely weak compared to that 138% run just since the beginning of the year. Also watching Rivian Automotive, ticker RIVN, is up 81% in less than 2 weeks as really strong production numbers prove the company can scale and compete in that EV market. Okay, shares are up 63% since recommending it as one of my favorite long-term picks in a March video. And if this company captures just a fraction of that electric vehicle market, it could still be a 10x stock. A company will easily beat its production estimates this year, and any sign of improving profitability is going to take these shares higher over that long term. Taking a look how the stock sectors did here on the sectorspiders.com sector tracker. Great free resource, shows you that big picture, how the big sectors did over the last week or year, 5 years. And we see that just one of the 11 stock sectors closed higher last week, with utility stocks nearly breaking even, nearly providing that kind of safety from the stock market. Real estate, really the strength there was impressive against the rise in interest rates. Interest rates rose from about 3.8% the week before, over 4% on the 10-year treasury. Could signal that we're close to a bottom in property stocks, that real estate was able to fight that increase in interest rates. Obviously, as interest rates increase, real estate extremely leveraged, so that's usually a negative for the sector. As I mentioned last week, I'm not yet ready to jump all in on these REITs, these real estate stocks, because rates will be heading higher. Office property pain is still building, but the next few years could be very good for real estate once prices drop through this year. Taking a little bit longer view, zooming out here to the year to date, we do see that energy stocks are down 7.6%. This year, they are, along with utilities, by far the worst performers, but still my favorite sector right now, and one of the lone areas of value left in this market. They are underperforming the market average by about 24% since January, and some of this is give back from the rally over the last 2 years. Energy stocks just boomed on those higher oil prices, but the price of oil right now, right around $73 a barrel, still supports strong cash flow through this sector. Okay, if we do avoid a recession, as the rest of the market seems to imply, oil prices can easily rebound to $100 a barrel next year. That's going to mean a return to healthy profits and massive dividend growth for these stocks. Investors will be watching inflation with the CPI, the Consumer Price Index report, here on Wednesday. Expectations are for the headline figure to come down to just 3.1% on a year-over-year basis. That would continue a positive sentiment from a drop to 4% last month. Though core inflation, that's what's important here. Core inflation, that ex food, ex gasoline, those volatile month-to-month prices there, still expected to be about 5% on a year-over-year basis. That's down from just 5.3% last month. It is still too high, and too high to avoid an interest rate hike by the Fed later on this month. If it does, that pace of disinflation, though, if it does continue, could be enough to avoid further rate hikes down the road. The start of second quarter earnings could be the sleeper news of the week. The market's going to be focused on inflation, but could get a wake up when banks start reporting this on Friday. Okay, I'm here on FactSet Earnings Insight. Follows the earnings every quarter. The market does now expect companies in the S&P 500 to report profits lower, a decline in profits by 6.8% from last year on revenue that's also going to be 0.4% lower. And that would be the third straight quarter of a declining earnings. Now, of course, companies will beat these expectations on the average, but it's clear the economy and profits are weakening. If we look further here into the third quarter, fourth quarter, and current year, market now expects another lackluster quarter with Q3 earnings growth of just 0.3%, but then to jump higher somehow with 7.8% profit growth in the fourth quarter. Now, I think the risk here is that companies, especially facing down that 7.8% expectations for fourth quarter profit growth, in attempt to lower the expectations on that weaker economy, they're going to warn investors that earnings could be lower than expected throughout the rest of the year. That could take some of the sentiment out of stocks and really give back more of that first half rally. What's interesting, though, is if we scroll all the way down to this FactSet Earnings Insight and look at here, this last chart, the S&P 500 sector level bottom up target price versus closing price. What this is the target price for all the companies in each sector by analysts. Okay, so the target price they have for all the companies in those sectors versus the recent closing price gives you an estimated upside to the stocks in that sector. And what we see here, energy, healthcare, utilities, three of the safest and best value sectors have the highest potential returns over the next year on those upside to target prices. Okay, we have energy with a 23% upside to those target prices of the stocks in that sector. Healthcare, another fairly safe, selling healthcare services, goods and services, things that we have to buy regardless of the economy. So more of a cash flow, less cash flow sensitive to the economy, expected to return 15.6% over the next year. And utilities, the ultimate safety sector, expected to produce 13.4% return over the next year. You see that in the sector tracker here, utilities down 7.25% since the beginning of the year. That's a lot of that is because of those rising interest rates. Obviously, rising interest rates means people can get more of a return in bonds, get those higher interest rates in fixed income investments, pulls them out of these dividend paying investments like utilities, like consumer staples. That's why those two sectors, although they are usually safety sectors, they have underperformed this year. But now the valuation, those dividends, and the potential upside return to those target prices, especially in these safety sectors like utilities, expected up 13.4% to those target prices over the next year, making them very attractive right here. Do not miss your opportunity to become an investor in the Let's Talk Money channel. Get that monthly income and the special perks and investor access with the link below in the description. Or click on the video to the right to see why Vanguard is wrong about stock market returns. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.